Good afternoon. Unfortunately, this is not a replay of our Monday live call. Events relating to the COVID-19 virus have, for lack of a better term, snowballed in the last few days, as reported cases in the U.S. have increased. And most importantly, public social distancing actions have heightened concern. But most importantly, the questionable response by our government has led to a loss of confidence in the market, which began last night shortly after President Trump's speech and flowing into this morning's open, where for the second time this week we triggered limit down, opening 7% down in the S&P. Interesting, aligning with our views, the market is looking for confidence in the face of COVID-19, as evidenced by an almost 1,200 point gain midday when the New York Fed announced a massive expansion in repo operations, which we'll talk about in a few minutes. Unfortunately, the market, and we believe the general public, are looking for government action and confidence, showing that they have things under control. As we discussed on Monday, in terms of COVID-19, outbreaks in the U.S. have continued, but the news isn't all that bad. We've seen actually positive reports coming out of countries such as South Korea on cases declining. In the corporate and high yield bond market, we're starting to see elevated signs of stress. We believe this is why the New York Fed acted so massively this morning and successfully. In terms of recession, the bottom line is how long and how deep will the impact of social distancing have on our economy? Clearly, some industries like airlines and cruise lines will face serious impact, and other service sectors may be impacted on a local basis. In terms of policy response, it's all about confidence, and the early returns suggest we need more. The Fed meets next week, and Congress is working right now as we speak to get a fiscal support package passed. So, Mike, from where we were on Monday, sort of take us from that point to where we are today and give us a sense of what has happened since Monday.
Monday obviously was an ugly day. S&P 500 hit a 7% down first level circuit breaker, but that was largely due to the news over the weekend from OPEC and basically the disintegration of the OPEC Plus alliance and the oil price war. So on Tuesday morning, the market was looking forward to a fiscal response and looking forward to details from the Trump administration, so much so that the futures market Tuesday morning hit a limit up. So it traded 5% up before trading was halted. Tuesday was a very strong up day, but ultimately no details of fiscal stimulus were released Tuesday night as expected. So on Wednesday, all of those gains from Tuesday were erased. Very disappointed that the market was very disappointed that no details were released, and that's when you start to look sort of under the hood at what was going on in markets. That's when the selling became very disorderly. Was on Wednesday, where very indiscriminate selling. Everything was being sold, not just stocks anymore. Municipal bonds, for example, had their worst day in over 10 years. So it was basically sell everything, only cash will do on Wednesday. That started to feed on itself and then escalated Wednesday evening when we didn't really get any details about a fiscal package or strong enough details about a fiscal package from President Trump's speech. And then also that's when the private sector and the public started taking social distancing into their own hands very aggressively. And Thursday, the market was basically in panic mode. Once again, everything was being sold. Biggest point loss or biggest percentage loss on the S&P 500 since Black Monday in 1987. We hit another 7% circuit breaker this morning. So it was very ugly.
So what do you think the poor reaction to the fiscal message was all about?
So on a high level, a lack of ownership and a lack of leadership, I guess, is how the market would grade the Trump speech. And then, also showing the market is taking this very seriously. And it's clear the public is taking this very seriously. Right. And it seemed as though maybe the government isn't taking it as seriously and perhaps doesn't understand the potential economic consequences of these actions that people are taking, and if this persists and if there's no fiscal stimulus. So with the lack of government leadership, the market and the public are forced to create their own narrative. And that today was panic.
Right, right. And so put this day, week, last 30 days into sort of historical context.
Yeah, so we just take a look at the S&P 500. So you're talking about in 3 weeks from the high on February 19th, down over 26%.
Yeah.
So first off, the bull market is over. The longest bull market in history. It ended today for the S&P 500. It ended yesterday for the Dow, down over 20% from the all-time high.
Right.
So that's done. If you start to think, what's our next technical support level? Really, once we get to the point where selling begets more selling, and this is just feeding on itself and there's panic, technical support levels kind of go out the window. But if you were to point to anything, you would say 2351 on the S&P 500 as our new line in the sand. That's a level, a lot of folks thought we would never get back to, and we're only 5%
We're not that
away
far
from
away,
there.
right.
That's the level from December 2018. So the bull market is over, and then right now we're about 23% below the 200-day moving average. So you start putting that into perspective, that's the biggest sell-off since 2008. It's pretty similar to the tech bubble and to 9/11. So it's huge. And then you start to think, well, once you get down at these levels and selling begets more selling, you almost have to just wait for it to exhaust itself, because fundamentals are basically thrown out the window.
Right.
So you start to think, when will this start to get exhausted? One thing you can look at is the VIX. The fear gauge, the VIX hit 75 today. That is the highest level since 2008. We're basically at the all-time highs. So fear is definitely at a high.
Yeah, it felt, being around back then, it felt like a day where there was exhaustion, where we just saw everything being sold, whether it was a good stock or a bad stock. Even stocks like utility stocks that were doing very well were just thrown out. And some stocks were down 10% that there was no reason why they would be down 10%. So as we look at where we go from here, what are the things we're thinking about as trajectories from this point forward? And we talk about how this could potentially recover. So take us through our scenarios.
Yeah, so the 3 scenarios we're assessing, and the probability of each playing out is changing daily as this sort of gets out of hand, and we're still waiting on a fiscal response. The first is a V-shaped recovery.
Right.
So that's sort of the most bullish scenario at this point. And what that sort of looks like is, we have our social distancing measures. We start to get into the springtime. The combination of social distancing, weather, and perhaps some type of a treatment, either an antiviral or development of a vaccine, causes the level of cases in the U.S. to top out much sooner than the market is clearly expecting at this point. And you combine that with a very strong fiscal response and a very strong monetary response, which we just saw a little bit of today, but still not the full thing. So you put that together and you think this can be very temporary. And we've seen how willing the market is to reward stimulus. We've seen it twice. Tuesday morning when they were expecting fiscal stimulus, and we had a limit up of 5%.
Right.
And then today, after the New York Fed announced stimulus measures where they basically took currently doing $60 billion per month of Treasury bill purchases, and they said, we're not just going to buy bills anymore, we're going to buy everything across the Treasury curve. So that's full quantitative easing.
Right. Basically signaling that we're not going to allow this to become a financial crisis in credit.
Exactly. Plus they expanded their repo operations, and that announcement alone caused us to have about a 4% intraday reversal. So you can see how badly the market wants it, and there are folks ready to buy if you get that. So that's sort of the V-shaped scenario. We resume this solid economic momentum we had, and it's sort of just a pit stop or a speed bump, whatever you might say.
Okay.
In our view, that's still a relatively high probability event.
Right.
I know it
doesn't feel like it at the moment.
It gets harder and harder to see.
Right.
But stocks don't go down 27% for no reason, right? It gets harder to see the bull case when you're down this much.
Right.
The next scenario is more of a U-shaped, and that's where either a lack of fiscal response or a insufficient fiscal response combined with the virus being more persistent and more resistant than we may expect. Maybe these social distancing measures continue into the summer months,
Right.
and that ultimately results in companies have to make very difficult decisions, and they have to start laying off workers. And we've already seen a bit of that, but just from, say, the cruise lines at this point. But if it becomes more broad, you can see how we could have an event-driven economic recession. And that would look more like a U, where it would take quite some time for us to get over this, and wouldn't come back to all-time highs for quite some time. We may still be talking about this in the fall.
In that case, we're down already 25+%. What does that look like in terms of the stock market?
Yeah, if you have there aren't enough of them to say atypical, but normal event-driven recessions or exogenous shocks that create recessions, you're down anywhere from 20 to 30%.
So we're
somewhere around there.
Pretty far down that path already.
Right. We're already down 27. So at that point, you think, it's ugly, but how much more downside is there? And then the last scenario, which the market is starting to price in more aggressively, is sort of an L shape, where ultimately you have everything you got in the U-shaped recovery, but it persists for long enough, and the fiscal response and the monetary response are so weak that this turns from just an economic recession, a business cycle phenomenon, into a financial crisis.
Right.
And then the banks are suffering large losses due to bad loans. Credit freezes up at a time where you can argue the Fed has fewer tools at its disposal, or those tools are less potent. And then that's when, it could take some time, 12 to 18 months, to try to recover these losses. Probability of that event is rising, but we still think that's the lowest probability outcome.
Right. I mean, as evidenced by the Fed's action today, they're standing ready to do whatever it takes, basically, to prevent that.
Exactly. They've heard this song before. They know how to dance to this tune.
They have a hammer, and this is a nail.
Exactly. And so we think next week when they meet, wouldn't be surprised at all if rates are cut to zero, and QE is expanded, and there's potentially talk about buying municipal bonds.
Right. So the strength of the fiscal response will determine sort of the path of whether we go into an L-shaped outcome or not.
That's right.
So in terms of those scenarios, what should somebody sitting there today be doing, looking at their portfolio, and more importantly, what should they not be doing?
So if you take those first two scenarios, which we still think collectively are definitely the highest probability outcomes, at that point, it's too late, and especially given how swift this sell-off has been, it's too late to think about de-risking from here. So you should be actively rebalancing your portfolio, because when this thing comes back, it's probably going to be a very sharp comeback, a very sharp rally. So you don't want to be off sides. The volatility, the swiftness of the moves, they've been so large that, a lot of folks, I'll bet if you go out and check your 401k, you may be 5 to 10 to 15% underweight stocks relative to where you want to be right now.
Right.
And when this comes back, you're really off sides.
Right.
So you should be actively rebalancing. We think it's too late. The market's moving too fast for you to think about dumping risk right now.
Right.
And you need to be thinking about, what are the companies that I want to own for the long term that look cheap right now? And it's prudent to start nibbling at those opportunities. Thankfully, all our clients were underweight equities heading into this thing. We've been rebalancing along the way, and we have a lot more room than probably most people to gradually start increasing stock exposure. And at this point, that, in our view, is the prudent thing to do.
And one of the things we talk about is the way down was one experience, but the way back up, we're sort of limited now in what we can invest in, because bonds aren't really an optimal investment opportunity, correct?
Yeah. I mean, bonds, their ability to serve as a hedge for equity losses and be basically an insurance policy, they've lost a tremendous amount of value in that respect.
They've done their job.
They've done their job, and they're retired.
They can do no more.
Exactly, and they're done. So you have to think about, what are the things I want to own in a 0% interest rate environment? because that may be the new normal here. It's the new normal overseas. This might be the cycle that gets us there. It probably is.
So what does that mean for the average person? What should they be looking at instead of fixed income?
So the one thing that we're getting very excited about is, that type of an environment plays to our style of equity investing, the style that we've been talking about for a few years now. Owning high quality dividend paying stocks that are giving you a dividend yield of 4% plus with good stable business models, strong brands, all those types of things. You think about, what's been going on here recently. You see Coca-Cola is down 10% today. Utilities companies are down 10% today.
Right.
These companies are playing
AT&T down 10%.
AT&T. These companies are paying dividend yields of 5% plus. Some of them don't have a tremendous amount of debt on their balance sheet.
Right.
That looks so attractive right now. And coming out of this cycle, it's going to look so attractive to so many people. If you thought the demand for yield, the search for yield was strong, from 2009 through 2019,
right.
Coming out of this, it's going to be just insatiable. It's going to be stronger than anything we've ever seen. And those types of stocks, we think, are definitely going to be in favor.
That's great. So some things to remember. Is there anything else you want to share before we conclude here?
Yes, I would say, you look at this market reaction and you see the social distancing measures, and, it's important to remember that this isn't because of the mortality rate of the virus. This is not related to that.
Right.
It's taking all these measures to make sure we don't spread the virus to folks that are at risk. But just a reminder, if you're under the age of 50, there hasn't been a single reported fatality.
Right.
The mortality rate is not insignificant and lives have been lost, but it's you put all this together and you would think the mortality rate was much higher. And then the other thing is, look at your life over the past couple weeks. How has your life actually been materially impacted? How have your buying habits changed?
Right.
Take a data point of 1. I'm still going to Target, still buying things on Amazon.
Yep.
All those things are still happening. And for a huge chunk of the U.S. economy, this is still business as usual,
right,
for the most part.
Right. So I think there's a couple things that we want to point out. The virus will subside, and we work with a lot of healthcare organizations, some outstanding individuals at those organizations, and we have extreme confidence that they will be shining in caring for those in need. And we'd like to personally thank all of them for the work that they do, because it's a lot harder than the work that we do here. And the other thing to remember is the economic impact of this is going to be short-lived, and it shouldn't do any permanent damage to the economy. The central banks around the globe have stated they'll do whatever it takes to support this and prevent this from being a financial crisis. And we believe that we've seen evidence of that. So, being experienced in these types of things and going through these before, we have a lot of confidence. And if you have questions or concerns, let us know, reach out to us, and we'll be here. We'll be coming back to you frequently, sharing our messages and our views. And in the meantime, wash your hands, and we'll talk soon.
Thank you.